Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 405 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Well, today is another Fundamental Friday, right? So I'm going to cover some fundamental topic, and I thought, given the inflation news that's been going around and all the thoughts on, what should be done about policy and all these types of things, I figured that today I would address the question as to what is the Federal Reserve? What does the Federal Reserve do, right? And I think that will give us a better idea as to actually how our monetary system works and how we are impacted by inflation and how the Fed could, if they chose to, and can and are stepping in to impact inflation, hopefully in a negative manner. So stick around for all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, hopefully in one way or another, everyone has heard of the Federal Reserve. And if you haven't, then today will be a good opportunity for you. It'll be a good opportunity for you to learn, and that's what Fundamental Fridays are here for, right? I want you guys to learn. I want you to know about some of these basic financial and economic topics. That way you can be more well-versed, right? You can be more educated on these topics. Now, let's just start with the basic, what's the Federal Reserve, right? The Federal Reserve is the central bank of the United States. Okay, so let's stop. Central Bank of the United States, right? What's that mean? Well, that means that they supervise the nation's largest banks. They conduct monetary policy and they provide financial services to the U.S. government, right? So they are the big bank. They aren't Bank of America. They aren't JP. They are over JP Morgan. They are over Bank of America. They are over all of these different banks, and they promote stability of the financial system, right? That's kind of what they're here to do. They're here to make sure that the financial system runs in the way that it is supposed to. Now, although its members are appointed by Congress, its structure is intended to keep it independent from political influences, which I'm just going to go ahead and tell you right now is so difficult. Now, we're going to talk about what the Fed is, how it works, all these different types of things, and then how it affects us. But I think it is important to note here that even though it is the independent Fed, it's not as independent as you would think, right? So yes, its members are appointed by Congress, but the president will pick out who the chairman of or the chairwoman of the Fed is, right? So for instance, Obama selected Janet Yellen, right, and she was the chair of the Fed for a while. Trump selected Jerome Powell, and Powell is being put back up for reappointment by Biden, right? So the presidents put these people up, and then Congress has to give their stamp of approval. So there has to be some political influence, right? Obviously, if the president gets to choose who they want, and then Congress goes in and either says, "Yep, that'll work," or "No," then obviously there is some political influence. And if you just listen to some of the rhetoric from some of the people who've maybe moved out of Fed positions like Janet Yellen, or even people who are still in them like Jerome Powell, you can definitely hear some political influence sometimes in the things that they say. Now, let's just go right into it. What is the Federal Reserve, right? What, if we define it, what is it, right? We kind of talk just at a baseline level what it is, right? But the Federal Reserve is the central banking system of the United States, and it has been around for over a century. The Panic of 1907 spurred Woodrow Wilson, the president at the time, to create the Federal Reserve System. He called for a national monetary commission to evaluate the best response to prevent ongoing financial panics, bank failures, and business bankruptcies. Congress then passed the Federal Reserve Act of 1913. So Congress originally designed the Fed to, quote, provide for the establishment of Federal Reserve banks to furnish an elastic currency, to afford means of rediscounting commercial paper, to establish a more effective supervision of banking in the U.S. and for other purposes. Since then, Congress has enacted legislation to expand the Fed's powers and purpose. Today, the Fed enacts monetary policy to manage inflation, maximize employment, and stabilize interest rates. It also oversees the banking system to protect consumers, right? We'll look into these tasks in greater depth as we go along. So the big things that the Fed is enacted to do is to keep stable prices, right? So that is inflation, managing inflation, and then to maximize employment. So keep the unemployment rate low, maximize employment for everyone. So how does this work, right? Well, to understand how the Fed works, you must know its structure. The Federal Reserve System has three primary components. There's 7 members of the, quote, Board of Governors, and they guide the entire Fed system. They direct monetary policy and set the discount rate and the reserve requirement for member banks. Staff economists provide all analyses. The 12 regional Federal Reserve banks work with the board to supervise the nation's commercial banks and implement policy. And then the Federal Open Market Committee, or the FOMC, as it's known, oversees open market operations. The 7 board members, the president of the Federal Reserve Bank of New York, and 4 of the remaining 11 regional bank presidents are members. The FOMC meets 8 times a year. And let me tell you, those 8 meetings don't go without a lot of attention from financial markets, and for good reason. Now, Congress created the Fed's board structure to ensure its independence from politics. Board members serve staggered terms of 14 years each, which those are long terms, but that's just how it works. The president appoints a new one every 2 years, and the U.S. Senate confirms them. If the staggered schedule is followed, then no president or congressional party majority can control the board at any given time, right? So what does the Federal Reserve do? Okay, I think this is the most important thing, right? So we said manage inflation, right? So this is their most visible function, and right now it is at the forefront because quite clearly inflation's a problem, right? Inflation running at 7.5% annualized, that is a problem. So as a part of this function, the Fed also promotes maximum employment and ensures interest rates remain moderate over time, right? So make sure everybody's working and make sure that interest rates aren't out of control. But the problem is that interest rates are used to combat inflation. And when inflation gets too high, you have to lift interest rates high in order to combat inflation, which slows the economy and hurts employment, right? So they are all in this continuous balance with one another, those 3 different things: employment, inflation, and interest rates. And it's hard to keep them balanced properly, but the Fed is enacted with doing so. Now, the Fed supervises and regulates the nation's largest banks and enacts laws to protect consumers, right? So like the Consumer Financial Protection Bureau, right? That's something that would be under the heading of the Fed and Congress quite clearly, right? And that would be there to make sure that predatory lending is not occurring and that consumers are well served by the banking system. Then they maintain the stability of financial markets and they constrain potential crises. And we saw that in the coronavirus pandemic, right? By instituting all of the bond repurchases that they did. That was a huge deal, and it helped to do what? It helped to constrain the potential crisis, right? It helped to keep the crisis from being any worse and provide liquidity into the market in a time of need, which was very, very useful. They lowered interest rates to very low, historically low numbers when the coronavirus pandemic hit. So ultimately, they can maintain, financial stability when there would otherwise be none. And then the Fed provides services to other banks, the U.S. government, and foreign banks. Now, let's take a look at that managing inflation portion of things, okay? So the Fed manages inflation while promoting maximum employment and stable interest rates. The Fed sets a 2% inflation target for the core inflation rate. The core rate strips out volatile food and gasoline prices because they have a wider range of volatility. On August 27th of 2020, the Fed announced it would tolerate inflation above 2% in the short term if it maximized employment. The Fed uses the Personal Consumption Expenditures Price Index, the PCE, to measure inflation. The Fed has many powerful tools at its disposal for this purpose. Its most powerful tool is setting the target for the federal funds rate, which guides interest rates. The Fed also sets reserve requirements for the nation's banks, which tells them what percentage of their deposits they must have on hand each night. The rest can be loaned out. If a bank doesn't have enough cash on hand at the end of the day, it borrows what it needs from other banks. The funds it borrows are known as federal funds. Banks charge each other for the federal funds on these loans. The Federal Reserve uses expansionary monetary policy when it lowers interest rates. This makes loans cheaper, spurs business growth, and reduces unemployment. And so naturally, the stock market absolutely loves when rates are lower because that promotes business growth, and that will promote growth of the bottom line, and will make it cheaper for companies to borrow, and ultimately for consumers to borrow as well, which will make them consume from companies, which will increase stock prices over time. Now, the opposite, when the Fed raises interest rates, which is likely coming soon, right? This is known as contractionary monetary policy, right? So contracting the economy. Higher interest rates make borrowing expensive, and increased loan costs slow growth and keep prices low, right? So if you have higher costs of debt, right, higher costs of loans outstanding, then what's going to happen? It's going to make it harder to grow as a company, as a firm, and you're going to want to stay as stable as possible until it may be cheaper to borrow again. Now, the FOMC, the Federal Open Market Committee, they set the target for the federal funds rate. Now, this federal funds rate is the rate that banks can borrow back and forth from one another overnight at. Now, banks set their own effective federal funds rate. To keep it near its target, the Fed uses the open market operations to buy or sell securities from its member banks. That adds to the reserves the banks can lend and results in the lowering of the federal funds rate. The Federal Reserve banking system is a network of 12 Federal Reserve banks under the supervision of the Board of Governors. These 12 banks supervise and serve as banks for commercial banks in their region. The 12 regional banks are the following. There's Boston, there's New York, Philadelphia, Washington, D.C., Richmond, Atlanta, St. Louis, Cleveland, Chicago, Minneapolis, Kansas City, Dallas, and San Francisco. But like I said, so Denver has a Federal Reserve Bank there, but it is under the heading of the Kansas City region, right? So there are many banks, right? I'm from Arkansas. I know Little Rock has a Federal Reserve Bank, but that's under the heading of the St. Louis regional Fed, right? Now, the reserve banks, they serve the U.S. Treasury by handling its payments, selling government securities, and assisting with its cash management and investment activities. Reserve banks also conduct valuable research on economic issues. That's something that's really valuable of these regional banks. They can keep up with regional data when it comes to the consumer, when it comes to the economy as a whole. Now, when it comes to maintaining the stability of the financial system, the Fed is the place to look, right? The 2008 financial crisis revealed regulations on individual banks weren't enough. The financial system had become so interconnected that the Fed and other regulators needed to look at it as a whole. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 strengthened the Fed's ability to maintain stability. Each bank with over $50 billion in assets had to submit a living will to the Fed outlining its financial health and ability to handle a crisis. This was to prevent other bankruptcies on the scale of Lehman Brothers. Now, the Fed's Large Institutions Supervision Coordinating Committee, LISCC, regulates the largest and most systematically important banks. It conducts stress tests to determine whether the banks have enough capital to make loans even in a financial crisis. So this is really important, right? This is a big part that the Fed plays. They are looking at all of these major banks and saying, if a crisis were to hit, would you be able to do what you're supposed to do? Would you be able to provide liquidity to financial markets? Would you be able to keep money flowing through markets? And these stress tests, even though they are important, I don't know how much value they've actually brought. I know there have been banks that have failed them in the past, but for the most part, they're something that just occurs, and banks know that they're going to occur, and they just move right along, right? They follow the rules and continue, but it doesn't always mean that things are going to work out exactly like they should. And it really also begs the question as to whether things need to work out for those banks or not, because as we've seen in the two most recent crises, right, the financial crisis and then the coronavirus crisis, right, we've seen in both cases the Fed step in a major way, providing liquidity to the market. So does it ultimately matter if these banks, these commercial banks, if they provide liquidity to the market in the way that they should? Does that matter if the Fed's just going to step in and be as accommodative as it has been? And ultimately, the more power you give to the Fed and allow them to have, are they ever going to give it back, right? Is there ever going to be a crisis again where the Fed doesn't step in? And that's what's really crazy is pre-financial crisis, the Fed didn't want to step in, right? The Fed, kind of wanted to, hold back and not really do as much and not save Lehman Brothers and not save some of these other banks that went under, that really struggled. They didn't want to save them, right? Because they didn't want to be too involved. But then, other big crises hit, and then you see that the Fed just steps right in and takes major action, right? And is, truly still taking major action. This month, bonds will still be purchased from the open market on behalf of the Fed in order to, ease from the coronavirus pandemic, which there's really no reason, in my opinion, for that to continue to occur, but it is still occurring, right? Even though they're slowing that and about to end that process in March, it's still occurring, which is still accommodative to markets, even maybe when it should not be. So the Fed is called the banker's bank because each reserve bank stores currency, processes checks, and makes loans for its members to meet their reserve requirements when needed. These loans are made through the discount window. Banks are charged the discount rate, which is a little higher than the Fed funds rate. Most banks avoid using the discount window because there's a stigma attached, right? It's assumed that the bank can't get loans from other banks, which is why the Federal Reserve is known as the lender of last resort, or the bank of last resort, right? So they don't want to come to this discount window, but that discount window is available to them if they absolutely need it. Now, that's what all the Fed does, right? That's the Fed in a nutshell. But who owns the Fed? Well, member commercial banks own the Federal Reserve by holding shares of the 12 Federal Reserve banks. The ownership doesn't give them any power because they can't vote. The President, U.S. Treasury Department, and Congress don't ratify the Fed's decisions, although the board members are selected by the President and approved by Congress. This gives elected officials control over the Fed's long-term direction, but not its day-to-day operations. So it's funny that this article goes here. It says it gives elected officials control over the Fed's long-term direction. But earlier on, it said, they're independent. They're not supposed to have, political influence. But like I said, there is quite a bit of political influence that can be had over a long period of time. But it is correct. Day to day, there's not much that an elected official can do to impact the Fed. But over the long term, the Fed, can be impacted by who's put into positions of power and left there. Now, what is the role of the Fed chair, right? The Fed chair, the most powerful person in the Fed, and many would argue the most powerful person in the United States. Now, the Federal Reserve Chair sets the direction and tone of both the Federal Reserve Board and the FOMC. The current chairman is Jerome Powell, a Fed board member. His term as chair runs from February 5th of 2018 to February 5th of 2022, right? So we've already run over it. Like I said, he's being reappointed or supposed to be reappointed. The previous chair was Janet Yellen, who is now the Secretary of the Treasury. Her term ran from 2014 to 2018. Her biggest concern was unemployment, which made her more likely to want to lower interest rates. Ironically, she was the chair when the economy required contractionary monetary policy, right? So she wanted lower interest rates, and yet she also was the chair in a time when the economy proved to need higher rates over time. And then before her was Ben Bernanke, who served as chair from 2006 to 2014. He was an expert on the Fed's role during the Great Depression, which helped him to take steps during the '08 financial crisis. This helped the economic situation from turning into a depression. Look, the Fed chair has a lot of power and a lot of sway in what they say and what they do. One of the more amazing things to me about financial markets is when the Fed has a meeting and then the Fed chair comes out and is doing their little speech or whatever, giving their their opinions, their thoughts, their facts based on the meeting that they had with the FOMC, and watching financial markets move as the Fed chair may say something, right? Watching the financial markets move as the FOMC lets out a statement, or as their minutes to their meeting are let out, right? Financial markets swing based on the chair, based on the tone of the chair, based on the words that the chair uses, right? This past year or two, the big word has been transitory, right? If you don't know what I'm talking about, then you should look it up. But basically it was, hey, is inflation going to be around or not? And then it's like, no, inflation's transitory. And then they dropped transitory from their statement, and markets reacted in a very real way because markets pay attention. And they are trying to get the most information they can from the most influential player in financial markets. Whether you want to admit it or not, right? You can say that the largest corporations are the biggest players, like Apple and Microsoft and Amazon, like they're the biggest players. You could argue that institutional investors like Vanguard and like BlackRock, like they're the biggest players. Or you could argue that hedge funds are the biggest players, or whatever, right? You could argue that commercial banks are the biggest player. But ultimately, the Fed is the biggest player in financial markets. And when they talk, people listen. And when they talk, people act, right? And the Fed chair has to be very thoughtful about what they say, how they say it, when they say it, and the impacts that it can have on financial markets over time. It is a very powerful and a very volatile job, and one that comes under a lot of scrutiny based on the decisions that they make. Currently, Jerome Powell and the Fed is under a lot of pressure because inflation is running really hot. And when inflation is running hot, people are going to call for higher interest rates, and they're going to call for more contractionary policy. And if that doesn't come and, inflation stays high, then, people are just going to be more and more frustrated with the Fed. So it's a position of a lot of scrutiny, but it's also a position where, if done correctly, can make sure that the financial markets in the United States have quite a bit of stability and long-term growth. Now, how does the Fed affect you? Well, the Federal Reserve has a significant impact on the lives of all Americans. The press scrutinizes the Federal Reserve for clues on how the economy is performing and what the FOMC and Board of Governors plan to do about it. The Fed directly affects your stock and bond mutual funds as well as your loan rates, right? Loan rates, I think, is the really big one, right? Why did so many, well, there's multiple reasons, but one of the reasons why so many people went out and bought houses over the past few years was because money was cheap, right? It was very cheap to take out loans. And you want to know why it was cheap to take out loans? Because of the Federal Reserve and the fact that they dropped interest rates to basically zero, right? And then obviously low interest rates have also been a big catalyst for the stock market and the ability to grow your money, right? So the Fed has a hand in all of those things in your life, whether you see it or not. By having such an influence on the economy, the Fed also indirectly affects your home's value and even your chances of being laid off or rehired. And that's kind of a scary thing to think about too, that such a large entity has, can have an impact on whether you keep your job or not, right? Because if they raise rates, then some companies aren't going to be able to borrow in the same way, and they may cut their labor force, and you may be part of that cut. Right? And so indirectly, the Fed cost you your job. It can happen, right? And it's definitely happened before and will undoubtedly happen again, right? But the Fed's making these large level moves that can trickle down into impacts on your life and my life. But they undoubtedly have impacts on the lives of all Americans. And I just think it's important to understand what they do, understand who they are. And I don't know if anybody outside of the Fed will truly understand ever what the Fed is and what the Fed does. But we have these general ideas and these general thoughts because, do we ever get the full transcript of, what's said in the FOMC meeting? No, we get the minutes and then we get a statement, right? But are we really ever going to understand what all goes into some of these decisions? Maybe not, right? But what we do know is what I've told you here, at least at a baseline level, what I've told you here. There's other things that you can learn about the Fed and the Fed chair and the powers that they have and the impacts that they have on your life. But I want you to understand the Fed. That way, when you hear about inflation, you hear about what the Fed could do for inflation, that you understand what that means, right? They could raise interest rates. They could stop repurchasing bonds from the market. They could even sell bonds to the market, right? And, that way taking cash out of the market to be more contractionary, right? And that would slow growth, and slower growth is going to lead to lower inflation as well. But it's all a big balance because they don't want to react and cause some large economic headwinds that could be problematic as we move forward. So that's what I know about the Fed. That's what I want you to know about the Fed. And I would implore you to look into more things and learn more about some of our nation's major economic players. That way you can be better educated and understand the forces behind financial markets, behind you getting a job, behind corporations taking out loans, all these types of things. It's all quite interesting, and it all has a very real impact on us, whether it may not seem like it on a day-to-day basis. In the long term, in the big picture, it does have an impact on us. And so I think it's our responsibility to learn and be better educated on these types of topics. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. Then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in next week as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.